Distinguished panelists, ladies and gentlemen, good morning. Thank you for joining us on Sunday morning for our last public panel of the Next Gen ESG Investing Program. I would like to thank our sponsors, Esg Partners, Star Magnolia Capital, Archipelago Capital Partners, and Vertex Ventures for graciously supporting our program. The Next Gen ESG Investing Program aims to identify, empower, and inspire the next generation of sustainable investors. All classes are delivered by leading industry professionals and is designed to support the preparation for the CFA Institute certificate in ESG investing. We also provide real capital for our members to put their learnings into practice and generate the investment track record. If you are interested to learn more, you may check out our website at www.genzgroup.org. Without further ado, we shall start the panel, How do Asset Allocators Evaluate ESG? We are very honored today to have Ms. Chia, CIO and Head of Portfolio Management and Research Office of Bank of Singapore, Ms. Devyani Daga, Senior Investment Director of Cambridge Associates, and Mr. Shinya Deguchi, founder of Star Magnolia Capital, with us. Please note that this panel is for information purposes only. It does not constitute investment advice. Please feel free to submit any questions you have via Q&A at any time during the panel discussion, and we will address them wherever we can. I will now pass the mic to our moderator today, Mr. Shinya Deguchi, to start the panel discussion. Shinya, please.
Tiffany, thank you. Good morning, everyone. Jean and then Devyani, thank you very much for joining today's panel discussions. We are pleased to have this the final panel discussion with you, the allocators, and the ESG world. So far, for the previous three panels, we invited public equity, buyouts, and then the venture capital managers. Behind the scenes, there is a group of investors called allocators, and also the people who make decisions. How to allocate the capital towards those ESG investments. So we think we are the drivers of ESG movements and then sustainable investing. However, the very little conversations and the media coverage exist on the allocator side. So today we are very pleased to have the distinguished the panelists, Jean and Devyani, to share our excitements, passions, and also somewhat struggles about the ESG investing. And you enjoy our the very open and honest discussions. And then, we are very, very excited about the long-term the prospects of the ESG and sustainable investing in Asia. So we'll start with self-introductions of Jean, please.
Yeah. Hi, good morning, everyone. And I'm really glad to be able to address a group of people that I don't often interact with, students, and as well as many in the industry that, in this open forum. And really glad, thank you, Shinya, as well as Tiffany, for having this fantastic Gen Z group, which I think is going to be a change agent for what will be a movement, if you like, for the next 20, 30 years to come. And really, we're talking to the generation that will define the future. So as far as us are concerned, I head up the research, discretionary portfolio management, advisory portfolio management teams, as well as the fund selection team at Bank of Singapore. And while we're quite different from, the traditional asset allocators that you know of in terms of pension funds or large-scale sovereign wealth funds, I do think that wealth management as a group is becoming an important force for change as well, primarily because the assets behind us, of course, of our clients are really families as well as multi-generational wealth. And this is a big trend for us in our industry as well, as we see wealth transfer from the patriarchs or matriarchs of many businesses that have the ability to impact change within their own businesses. They also have to put long-term capital to work in a meaningful way. And this becomes part of the investment DNA of our industry that will define the future for ESG priorities and conversations as well. So I do think that this type of an arrangement that we have, or network that we have will become an important one in the years to come. Yeah, thank you.
Oh, thank you, Jing. Hi, Devyani, you're next.
Thanks, Shinya, and I echo Jean's sentiments on what this panel stands for, and all of the participants listening into this panel. And thank you for spending your Sunday morning with us. My name is Devyani Daga, and as Shinya said, I'm a senior investment director at Cambridge Associates. Cambridge Associates is a global investment advisory firm, and we work with family offices, family clients, endowments, foundations, and pensions all across the world to help manage their assets and advise on asset allocation and manager selection. And we do this across asset classes, including both public and private asset classes. And we are very fortunate, to be working with a number of clients globally who've really been thought leaders in this sustainability and impact investing space. And it's been quite a journey, and we've learned alongside our clients. And I'm hoping to share some of the insights that we've gained and how the industry and our contribution and involvement in this space has developed over time. And yeah, excited to hear Shinya's questions.
Great, thank you, Devyani. So today, we have the two different allocators, one from private wealth management representing wealthy families, and then Devyani representing mainly institutional investors. So you will see some differences between two different allocators, and then their perspectives as well. And then that's a very exciting, the part of today's the panel discussions. But then before we start, there's the common aspects, among two of you, which is the Asia. And then the Asia is relatively new for ESG. And then I remember, Devyani, you moved to the Singapore from London right before COVID-19. So I'll probably say, I shouldn't say it was a very exciting move because you didn't have a lot of time, opportunity to enjoy the Singapore. But then maybe I would like to start what you found, and then in differences between maybe a development stage and then understanding of ESG and sustainable investing in Asia compared to Europe and then also North America that you represent previously.
Sure. So you're right. I moved right before the COVID pandemic hit, and I think I was quite fortunate in the timing. I think 6 months later, I would have been in trouble. And it has been really exciting working with clients in the region. And I work with clients in Singapore as well as Hong Kong. And the portfolios that we build as an organization are global portfolios. So even though we work with clients in the region, the portfolios that we represent and build are globally diversified portfolios. In terms of how clients approach sustainable investing in Asia versus Europe, where my majority of my work experience has been, I find that Europe, and this is kind of well documented as well, European investors are generally ahead of the curve, and they are considered to be thought leaders in sustainable and impact investing. And you can see this not only in terms of the work that the investors are doing, but also in terms of where regulation in Europe is with respect to, reporting requirements and what is required of funds, etc., with respect to ESG. And the firm Cambridge Associates is headquartered in Boston, and obviously a lot of the sustainable investing work that we do, is done out of our US offices as well. And I find that the focus between the different regions is different. In Europe, for example, there's a huge amount of focus on climate change. And, in US, there is a lot of focus on racial equity, a kind of gender-based investing alongside climate change. But we see that as less of a focus in Europe. Not to say that, European investors are, not involved or, excited about these areas, but I think that the focus is more on climate change in Europe. And in Asia, I would say that the focus is definitely more on climate change, but it's also a bit broader. So it's not very thematic. It's not kind of saying, I want to address this specific area, but it's a little bit kind of one step removed and saying that, I want to incorporate sustainable investing in my portfolio. I'm going to define it very broadly. That it doesn't have to be related to a specific theme, but I want to do it so long as I don't have to sacrifice returns, I don't have to sacrifice diversification, and everything else being equal.
Oh, that's quite interesting. So maybe, Jing, may I ask your experience? You're based in Asia, and then seeing, the many of the Asian high net worth wealthy families, and then, what do you think the driver, and then how do you see the current ESG and sustainable investment, the development status?
Yeah, thanks for the question. And I cannot profess to know anything about Europe and US from my experience, because frankly, in terms of Asia, that really is where I began the ESG journey. But because we do run a set of funds in Europe as well, I'm familiar with, of course, the EU regulations that have impacted fund managers globally as well. So I'd like to say two things, right? I think Asia is a very exciting place to be from a climate change and ESG perspective, primarily because the delta is going to happen here. Asia is home to a lot of climate-related and ESG-related, I'll say like the starting point. First of all, the major carbon emitters, many of them are in Asia, whether it's China, Indonesia, and parts of Southeast Asia. So there goes the opportunity. A lot of the forests that exist in Southeast Asia, as well as larger parts of Asia, are also, sort of the crucible, if you like, of all the biodiversity that we are able to preserve. So as far as Asia is concerned, I think it's twofold. In terms of the form, we're definitely lagging behind, whether it's EU regulations on taxonomy, reporting standards, what we do not have, what SFDR, for example, classification, etc. But you can see that the Asian regulators are catching up really, really quickly. So the MAS has come up with guidelines, HKMA has had consult papers, and of course, even in Southeast Asia, some of the standards that have been rolled out for corporates in terms of reporting, compliance to TCFD, etc. So I see a huge catch-up going to happen in the next couple of years. China, I think, is critical and will be the defining factor as far as the speed of adoption and also change. So we do think that while China can be accused of being one of, it's a very politically charged discussion between US and China with regards to climate change. We are heading into COP26. So I do think that we will see a lot more forceful, not just rhetoric, but policies around climate change. And then the second question, of course, is Asia ready? And that's where the complexity is going to be in terms of what is Asia's path. So as pioneers, if you like, all of us are, primarily because there's no playbook. There's nothing we can really rely on, even from a European perspective. Some of it may be relevant or irrelevant. The US is not that far ahead as well. So I do see a huge opportunity for Asia in also defining the future, because the change could be, from a climate perspective, actually here in Asia in a very meaningful way as far as substance is concerned.
Oh, that's interesting. So you see, the very big difference. Maybe I shouldn't say big differences, but then, some differences between Asia and then the rest of the world. Maybe because of the, the cultural differences, maybe the difference, the stage of the economic developments as well, and also, what the society really needs. I think that's a driver of the future ESG. But I'm curious, Jing. What is your conversation with your, the high net worth clients? Are they, they really interested? Are they the drivers, or you are still, trying to educate them? This is the way they should consider investing.
Yeah, it's a very complex discussion with our clients, and also very diverse. So I would say that the awareness has increased significantly over the last 12 to 18 months. For many reasons, I think COVID-19 did have an impact on how people look at investments for the long term, and also the risk element of the portfolio. So, climate risk has emerged as a potential risk for the future. Now that we know that when a pandemic does happen, this can really be so, devastating, not just for economies, but also for portfolios all over. And then the whole argument over spotting risks from a governance perspective to begin with has also been catalyzed by what's happened in China in terms of, say, for example, the China property bond market. So that huge volatility that we saw in relation to what were corporate governance risks before might have been ignored, but there's nothing like hitting your own pocket to as a wake-up call. So I think that conversation is definitely much easier today. The whole concept of risk management, spotting of governance risk. Then speaking of climate as well, I think there's a huge dilemma in Asia and Southeast Asia amongst business owners who are many of our clients as well. They are facing pressures on two angles, both in their own businesses, as investee companies for many large pension funds and global fund managers. They are facing that challenge of how to step up from an ESG perspective. And so that translates also to awareness about their own investment portfolios. And so that conversation has also become much easier. So it's really a supply chain or ecosystem that we're talking about when we as investors maybe impose certain, I'll say, standards on corporates. They also evolve in terms of awareness and consciousness about how they invest their capital. So it becomes a very symbiotic chain as far as large business owners are concerned. Now, in terms of high net worth individuals, and really, I always say there's no real difference between retail and high net worth as far as investments are concerned. It's just, is it 1 million or 100? I think in that spectrum, awareness is very key. And so to that end, I think we do a lot of education, a lot of training, not just for our clients, but also our relationship managers, our sales force, our advisors, to really understand the dichotomy that we face. One major challenge I would highlight is that many investors still see ESG potentially as a trade-off. Like, do I have to give up? Do I really have to do good? In my portfolios, I can do it directly. I can donate in philanthropic purpose, but investment is different. I think there's still that mindset in some quarters. It's gradually changing, and I'd like to maybe discuss a little bit later about whether that's even a relevant discussion, in investing, and Devyani will have a lot on that front as well.
Sounds good. Oh, thank you very much. That's the very detailed answer. Devyani, what do you think in your world, the institutional clients, especially in Asia? I know they are more they are investing globally, so maybe they are the sentiments and then the perception might be a little bit different. But then, would you like to share what you think or what you see?
Sure, and I think. So one thing I'd say about sustainable investing in ESG is that no two investors will have the same goals. No two investors will have the same definition. Even for one investor, one institutional investor, if you sit the investment committee around the table, every one of the committee members have a different take or different definition of what sustainable investing means for them. So what our clients are pursuing is quite different, and what their goals basically intricately what their goals are quite different. But I think the common thread is that there is a recognition that sustainable investing it has become mainstream. And I think the evolution of the industry is quite important and relevant here, because I think the reason why for a lot of the institutional investors, maybe 5-10 years ago, this wasn't being considered is because, ESG or sustainable investing was considered concessionary. And to Jean's point about the trade-off, there was always this decision to be made that, if I do this within the portfolio, it's not going to earn me a market rate of return. So I might as well not have any of these constraints or these kind of considerations in my portfolio. I invest the portfolio 100% to maximize return. And of that return, I use that return to fund my mission or to fund whatever philanthropic activities I want. I think that was the long-held belief maybe 5 or 10 years ago. And we have seen that evolve because as, more data has come in about sustainable investing, about managers who've been very successful in this space, as regulations and what's happening around the world has made this more and more relevant for client portfolios. We are pleased to report that this narrative has definitely shifted. Sustainable investing is no longer considered as concessionary. I think this is widely recognized across our client base. The kind of manager recommendations that we make, this is not to say that invest in this manager because they'll do good in the world, but you have to sacrifice returns. returns. In fact, the narrative is that invest in this manager because they're considering all risks that are relevant for investment portfolios. They are building future-proof investment portfolios, and they are thinking beyond the traditional measures of risks such as standard deviation and volatility that are just looking at backward-looking numbers and historical data that might not be the most relevant, most holistic measure of risk going forward. So that is really how our clients are thinking now. And, in that vein, also, we believe that, sustainable investing is a risk management tool, but also it's a return enhancement tool. Because if you think about, when we think about active management, and we think that managers who have, all the relevant data sets, who have more information to make better investment decisions are likely better placed, to do better than the benchmark and their peers. Sustainable investing data is an additional data point for managers to incorporate and consider as they make their investment decision. So if it is used correctly, then it could lead to better value. So apart from risk management, it could also lead to better returns. And our clients are definitely identifying with this philosophy, and increasingly for our clients, both our clients, that there might be a client who has a sustainable investment policy in place, and there might be another client who has no such policy in place, but they might be investing in the same manager, and this manager might be thinking about sustainability holistically, because we believe that it makes sense to hold this kind of manager in all portfolios, regardless of whether the client is thinking about sustainability or not.
Yeah, well, that's interesting, and also very encouraging that a lot of your investors and clients are the shifting from the concerning the ESG as a risk mitigation to return enhancements. Jing, what do you think? Do you see the same type of the movement and shift among families, or maybe your client base?
Yeah, so amongst our own analysts, when we started on this journey, we actually used a framework internally, which we had a neat acronym for, which is REAP. So research-based, ESG excellence, and then assessment, and then portfolio performance as well as process. So I think increasingly we are learning from the large-scale pension funds and asset owners and institutional managers to understand that ESG is no longer a sideshow, but really an integrated approach. So even amongst our own analysts, especially at Bank of Singapore, where we cover mainly emerging market issuers as well in fixed income space, as well as Asian companies, we increasingly also integrate this approach within our investment process. So as you rightly point out, Shinya, it's really part of a holistic approach to looking at a company. So I have a couple of examples even within our own coverage. So I do see, for example, some of my analysts who have a very high ESG frame for a certain company because the practices are superior. However, on a valuation standpoint, this company could be a sell, but it's all about time frame. So in the short run, a company could be overvalued and in terms of investment, not as viable, but they are doing the right thing from a long-term perspective. And on the flip side, there are companies that may be extremely attractive from traditional financial metrics because of growth prospects, shorter term growth prospects, but really not doing the right thing as far as the longer term is concerned. So the question is, this just becomes another additional aspect that we have to be very conscious of, because at the same time that a company may be doing poorly, say for example in labor practices, a Latin American beef producer, for example, could be an issue in terms of their carbon footprint. But if I look at it from a long-term perspective, I could also take the view that this is a company we can influence, that while it's a very attractive investment right now, we will need to monitor whether there is positive delta in terms of what they're doing from a business perspective, business practices perspective, on the labor front, on the carbon emissions front. So I think it just makes for a much richer investment process, which takes into account more holistic aspects of a company rather than the very superficial shorter-term priorities, and that becomes, as I mentioned, less of a trade-off if you think about it that way, because in the long run it is not a trade-off anymore. It is actually a very important issue for performance and risk.
That's interesting. So I particularly like that, your actual experience, the ESG, excellent ESG evaluation was, actually a sell. So, but then still, they're covering those companies because in the future, there will be, the interesting investment opportunities. And because I think ESG is a long-term issue, not the short-term issues. Valuation could be a short-term issues. And then I think this is kind of a, the winner's dilemma because the good ESG companies tend to be overvalued. Right? And then I think a lot of, the articles talking about, oh, does ESG investing work? And then because, if you keep investing in, high score ESG companies, yeah, the valuation is high, right? And then, the marginal return opportunity, upside opportunities is probably quite limited. But then it doesn't really mean that, the ESG investing or sustainable investing, the wrong approach. So I think that's the very interesting points. But then now I think your team fully understands the importance of this, the ESG integrations. But then you shared when we had the discussions, the very interesting experience at the very beginning. Maybe a couple of years ago when you start thinking about this, and then you had interesting experiences with your internal teams. Can you share what kind of conversation you had, and then how the team changed?
It's interesting. This is the behind the scenes, if you like, right? And I think it's about cultural change within organizations and also our own industry. And many of our audience are students, so perhaps it's less relevant for them in terms of they don't have this baggage that we might have in the investment world. So initially, when I broached the subject of creating an ESG factor within our research process, some of my analysts, who are from the emerging market fixed income space, were actually very skeptical and also resistant because their perception was, their coverage universe tends to be energy intensive, as well as with potentially, poorer ratings as far as ESG is concerned. And so this resistance, it's not so long ago, maybe about 12 to 18 months ago, gradually changed over time, especially as we dug deeper into the subject matter. What was very encouraging was, when I asked everyone to get some form of ESG certification, here's a little plug for CFA ESG, actually the team was very open to that. And, whether it's not just the CFA, but there were also risk related courses that were available. Others were more climate related, etc. But everyone just embarked on their own journey to learn more about it because it's such a complex and evolved topic at this point. So with learning more, typically what happens is then your understanding and the skepticism or cynicism actually dissipates because as you know where you stand, I like a quote by Oscar Wilde, which is quite interesting. He says that a cynic is a person who knows the price of everything but the value of nothing. So sometimes knowing what you don't know is just as important because it gives you that hunger and the opportunity set to become a better investor. And so, fast forward, 2021 was one of the record years for green bond issuance, social bonds, sustainability bonds. So it becomes ubiquitous. It's not an option anymore for you to say, I'm not interested or I don't think this is relevant. I think the market itself has moved us into a new space where cynics probably have less room to stand now because it's a wave that they can't fight. And I'm confident that as regulations become much more stringent, both on the investment front as well as on the corporate front, it's a wave you just can't fight anymore.
Great. Devyani, I know Cambridge has been focusing on the sustainable investing, and then probably was not really called ESG back then. But then, what was your the organization's internal development of understanding the ESG and sustainable investing, and then where it's heading?
Sure. So as you rightly said, we've had an internal team focusing in this area for over 10 years now, but it has increasingly, the team has grown and the emphasis of the organization has grown over time. And as I mentioned, a couple of days ago, Cambridge has signed a net zero pledge, and we are going to be aligning all discretionary portfolios where we have investment management decision authority with net zero in the next 2 years. And we are increasingly having conversations with all of the clients that we work with on an advisory basis, with the intention of, putting this forward to them and getting their views, and then finding, where the clients want to land over the next 2 years as well. And that is a huge step for Cambridge Associates. Where we were maybe 5 or 10 years ago was, we had clients, who were interested. We had clients who weren't interested, and we were kind of, we didn't kind of take a stand either way, because we work with both sets of clients, to be quite honest. And as we've worked with our clients who've been pioneers in this space, particularly in Europe and the US, and the investment opportunity set has developed, the manager landscape has developed, we've seen what our client capital can actually do, and kind of our own thinking about the role that sustainability plays in portfolios has developed. That has led us to taking this position today. And even though we have a separate team, it's called the Sustainable and Impact Investing Team, just to add another acronym in the whole alphabet soup of SRI, MRI, ESG. This team focuses on manager research within this area, as well as, you can go to our website and there's lots of really interesting research reports and content around this. Really, this is integrated across our asset class research. So we have over 200 people covering variety of asset classes in the research team globally. And every single one of them, all the managers that we cover, we ask this question, whether or not the manager is classified as an ESG manager, or whether or not the manager has sustainability in their name. Because as I mentioned previously, there might be managers that, and we've worked with so many managers that don't have sustainability in their name. They don't advertise themselves as managers who are thinking about sustainability, but they've been doing it for 2 decades, because that's just their risk management process. So, apart from having a team that focuses specifically on this, having this integrated across the manager research process and just making sure that we've got all bases covered has been really important. And that has been an important thing for Cambridge Associates to do, to build resources in this area and to refine our own internal processes so that we have full coverage and we're able to find good managers for our clients.
Oh, that's interesting, because one of the biggest concerns for the industry right now is greenwashing. And then sometimes, the great managers, great companies, they're not really, the self-promoting, and they don't have to say, oh, we are ESG conscious companies or sustainable focus. But then the long-term successful investments and managers, they're always conscious about this because it's deeply integrated into their system. So now the question is, what should we do in order to assess those, the investment opportunities? The people who are a little bit shy and then they don't want to, openly speak about, these issues. But then we kind of know that, they are actually very good practitioner of the sustainable investing. Maybe, if you can share, some tips, like how you actually do this. And then maybe, is that the ESG ratings or maybe analysis, or maybe, is it based on the, the quantitative analysis or more, the qualitative, the conversation based? Maybe starting with Devyani.
Sure. And we, like I said, our manager research coverage is very thorough. And what we have just found is that it takes a lot of resources to properly cover the space, because it is a constantly evolving investment universe. And, our ESG evaluation criteria is completely integrated with our manager research process. So we look at, what are the managers saying that they are going to be doing, or what are they saying they're doing, matching that up with whether they have the resources and the skills in-house to be able to deliver on that, and then assessing their portfolios independently to see whether their portfolios align with what they're saying they're doing. So we have managers report data on sustainable or on their sustainable investment practices to us on an annual basis. And when we look at that data, we don't rely on just the manager data itself. We use the MSCI ESG tool to actually evaluate every manager portfolio and see where it stands with respect to what the manager is claiming that they're doing. And then we also look at manager voting records, etc., and see whether that aligns with their views on climate change, for example. Have they been voting in a way that makes sense and aligns with what they are saying to us on climate change? And we've done training in-house for our research team, and this is a constantly, like I said, evolving area, and the training is pretty it's pretty ongoing, and we are all learning alongside our clients and prospects.
Oh, excellent. Thank you. How about you, Jing?
Yeah, thanks for the question as well. I mean, on for the fund managers that we work with, I think there is a risk of what I would call the tyranny of the large. So the large companies, as you mentioned, are able to claim that they have larger teams, for example, longer history, etc. And that, of course, will lend itself to European or mega trillion-dollar fund managers, right? So resource-wise, it is hard to beat in terms. And Shinya, you rightly point out that there are, of course, a lot of boutique fund managers who really truly believe and have been practicing this for many years and maybe less visible. So it is a combination of qualitative and quantitative criteria. So on the quantitative side, I think we do, of course, rely on ratings, whether it's MSCI, Morningstar, etc., and all forms of that. But beyond that, I think it's really important for us to engage in the conversation with fund managers to understand their starting point and where they're coming from, and also the milestones that they hope to achieve, very much like how we approach investee companies as well. So I do think that there is room for greater research within even funds, especially for lesser known fund managers. I think there's a big gap as well in alternatives. So in the hedge fund as well as private equity area, I think it's still fairly nascent in terms of how to assess companies or fund managers in that respect. So I do see that also as an opportunity. Perhaps some of the broad brush approach that we are doing, perhaps in the mutual fund industry, will need to be a lot more nuanced in hedge funds, because on the surface, it may seem that they are not as clean, if you like, as the maybe even ETFs. But on the other hand, the impact that they are able to create could be actually larger. Of course, there are also a lot of studies now being done that, on potential greenwashing. And indeed, if I look at the performance of the past year or so, a large number of ESG funds were actually in technology stocks. So that drove performance because we are because the sector performed well. And then, but in terms of whether there is, impact, I think that needs to be assessed, and whether that's a coincidental indicator or whether that's a causal relationship. Because on the surface, they would look like they have no energy exposure, for instance. But the large tech exposure, the question mark is, what impact does that have on climate change, or indeed now the very controversial working and social practices.
Yeah, that's actually very good points. And then and I thought that was excellent points, because I think the software company, for example, they tend to the mark high on especially E, because there's almost nothing to do with the environment. But then by investing in those companies, or these companies actually making a positive influence to the world, and then maybe E is neutral, not necessarily positive, I think. Or maybe if there's the energy companies which is actually making the conscious efforts from negative to neutral, or maybe potentially positive, that actually has a lot more the impacts to the world. So I think I think our industry have to improve, and then I think some some people actually they're doing this already, but then I think sometimes we have to change the focus, and then how to measure the successful ESG and impact investments, as you said. Anyway, so I have a couple more questions, but then just like as usual, this ESG the panels discussions, the audience is very keen to ask a lot of questions. So we are already they're receiving a lot of questions. So I'm just moving to the Q&A sessions a little bit early so that we have the chance to address those questions. So the first question we received is for fund selections. Are there enough managers with proper ESG policy to choose from in Asia? That's a good question. Okay, so if the universe is so small, then probably ESG investment process probably doesn't make a lot of sense. And then the attendee is asking, do you think you have to compromise your selection criteria to be invested in ESG managers? Okay, so these are tough questions. I don't know how the open can we be, but then maybe Devyani, do you have any views on this?
Sure, and I think it's a completely accurate observation that it is more challenging to find managers. The opportunity set is for sure smaller, but I think the positive news is that, and there's a couple of reasons for why the opportunity set is smaller, right? The disclosure in Asia, if you think about China, the ESG data disclosure, starts off from quite a low base compared to globally. The quality of ESG data that is disclosed is also, sometimes it's not adequate, but the trends that we've seen is that the data disclosures have been improving. More companies are disclosing data, and more companies are disclosing adequate and good quality data, and therefore the manager landscape is also evolving, and we've seen some positive trends there that more and more managers are doing this thoughtfully. So I don't think we are not compromising on the criteria that we are using for our client portfolios, but there are fewer managers to choose from, I think, definitely. And I think when we think about client portfolios, there's a couple of things, right? You have to make a plan for, this is what you want to do in the medium term to long term. This is what I want the ESG characteristics of the portfolio to look like. And in order to get there, we don't have to get there tomorrow. I think it's more important to define a path and say that, we want to do this, not at the cost of returns, not at the cost of diversification. And therefore, as the manager landscape evolves, we want to also evolve our portfolio and, where possible, support the evolution and the development of this manager landscape. So it doesn't, the opportunities that doesn't really constrain us. And it is a journey for most of the clients that we work with.
Got it. Interesting. Jing, do you agree with
Yeah.
Devyani?
So Asia is definitely a smaller opportunity set. So if you look at research from MSCI, for example, they did a piece on the top 15 asset managers by AUM, and then they applied the SFDR Article 8 and 9 lens onto it. And within the Article 9 funds, for example, only 3% are invested in Asia, and Article 8 funds only 11. So for those who may not be familiar, in Europe, the Article 6, 8, and 9 categorization actually defines the types of funds. So these are more sort of ESG-oriented funds. So it's quite clear that from the contrast, right? Global funds, there's like 83% Article 9, but only 3% in Asia. So it is a natural challenge for us as well. But being Asian fund managers ourselves and managing money ourselves, we also understand the challenges that fund managers in Asia are confronted with, the lack of data, the lack of transparency, the lack of standards even. So, and to be fair to Asian managers, the environmental risk management guidelines for Asia, or for Singapore even, only just was published, at the end of 2020. So there will be time required for us to adapt and adjust our practices, and to even be, like you said, vocal about it, because the risk today is making claims that you cannot meet is even riskier than not meeting those those guidelines potentially. So I think we are quite circumspect as Asian managers to really be ready to make any claims. So, and that's fair. I think that's the right thing to do. So as a fund selector, then it means that we also have to have a certain tolerance level. I won't call it a compromise, but a different approach, right? One of the approach is, for example, track record. So in most fund assessment, you will want a 3-5 year track record, whereas some ESG managers or funds that are focused on ESG may have a shorter track record. And so are you willing to tolerate that lack of track record in favor of a very robust process. I think that's an important consideration for us as well in supporting the transformation of the industry. Clearly also for Asian high yield and emerging market high yield, we have the same challenges and also approach to really look further, a bit deeper into process as opposed to track record.
Got it. Okay. Thank you. Next questions is, I think, the Jing probably partially answer answer these questions, but then it says, how would asset allocators achieve investors' aspiration to make positive impact towards climate change in Asia? And then I recently read the very interesting article on the Science. This is one of the journals about the recycling of battery. And then it's actually quite hazardous, and it's very difficult and very expensive. And then the growth of electric vehicles is amazing. And then I think this is going to change the world or maybe industries. But then I'm not even sure, a lot of electric vehicle companies are addressing these, the issues as well. What's going to happen, after the battery being used. But anyway, how we can actually assess, are we actually making any positive changes through investing, allocating to those managers? And then can we actually measure, our success in this way, not just, the performance wise?
So in terms of actual, for example, emissions and so on, right? You say. So I think there's the industry and actually, I mean, the auto industry is also evolving in that sense. And what's very encouraging is Asia is actually taking a lead in terms of battery technology. So the leading companies are actually South Korea, China, and Japan in terms of, it really creating a much more efficient, firstly, cheaper, and hopefully less carbon intensive technology for the auto industry. Now, transportation is one of the largest culprits for carbon emissions. So that's important for us to recognize. I think the larger question I would say is there is a lack of pricing for negative externalities. So carbon pricing is not homogeneous in the world today. So in Southeast Asia, the carbon price blended or average one is about $5 to $10. In Europe, under ETS or your emissions trading system, the price is 170 or 75. This is a huge disparity and also a negative externality that's not priced today in Asia. So if you want to apply that to corporates, to industries, I think the entire decision-making and incentive process will change. And that is going to be a catalyst also to produce much more efficient and cleaner battery technology that can actually be either easily recyclable or have longer lifespan. So they are very complex topics, but at the end of it, from an economics point of view, like if you put on your economics hat of allocation of resources, I think the root cause is capital is not efficiently allocated using carbon metrics. It is today allocated more on return. I mean, I'm not a big fan, for example, of e-commerce. I know a lot of you probably shop online. For example, I look at my daughter's ordering of one single item, which is bubble wrapped, sent to the home from many, many miles away. And I look at the cost that was, it's again, you can ask yourself, does the world need another e-commerce player that private equity funds just pour into to actually promote a practice that is potentially not very green? But there's no price to it because, you get free shipping. Today is 10/10. So, guys out there, I know you are all going to be clicking away. But you ask yourself if that was an efficient allocation of resources in the economic sense of the word, I would argue no. So I do think that carbon pricing will change that significantly in terms of behaviors of individuals. And then if that's passed on to consumers, there will be massive repercussions. Of course, that's a huge topic. I mean, it's a webinar or a thesis in itself. But, there's a lot of also negative incentive issues that could arise from carbon pricing that I acknowledge. But certainly that's a really big area for us to look into from a science-based approach as well as from an economics approach.
Yeah, I totally agree. When I have a grocery delivered, and then I feel bad about so much, the garbage and the waste after, the excessive wrapping, to protect the vegetable, because if I go by myself, then probably, I don't need this much of the plastic, the wrappings. Okay, thank you very much, Jing, for the questions, for the answers. Let's move to the next one. This is about engagement, your engagement with the companies and then the managers. Will Bank of Singapore and the Cambridge Associates pressure their managers or companies to engage with this ESG, the solutions? Are you, trying to be more, active, or, the more the passive? Maybe starting with Devyani.
Sure, and I think I'd say that it's not pressuring, but it's signaling. And the signaling is, by way of, what we do as a firm, and as I mentioned, our net zero pledge, and then also on behalf of our clients. So for some of our clients who have sustainability policies, we will reach out to all of the investment managers, whether or not the investment manager is a kind of SII or sustainable ESG manager, and say, this is my clients, this is your investors' sustainable and impact investing policy, just FYI. So they know that, that is where the capital is headed. So I think the signaling is, so it's not pressuring, it's kind of signaling and indicating that is where the market is moving. That is where we as a firm are moving. That is where our clients are moving. And then it's secondly, where managers do come to us and say that we have a sustainable and impact investing policy, as I mentioned previously, there's 100% accountability. So we do hold them accountable. And there is a lot of emphasis on making sure, as I mentioned previously, that what they're indicating to us on the tin is in fact how they're investing the portfolio.
Got it.
Yeah. In terms of investee companies, we don't have a stated engagement policy today. But as Devyani mentioned as well, I think for us it's similar, that it's more an engagement process, if you like, that over time we want to see positive delta in terms of whether it's how investment is made within the funds. And so I think that it's a journey, and especially for us, I think it will take some time to evolve that policy as well. So I wouldn't characterize it as pressuring by any means at this point in time.
Right, but I think as an allocator, we are making they're sending a very important signals by not allocating the capital or not investing in those companies, and then I think that should be the most important drivers. But then I do understand some people want to be more active, and then there are a lot of the investors in the public space, they want to be an activist on those ESG matters, which I found quite interesting as well. Okay, the next question is about ESG rating. So the question is a little bit long, so I'm not going to read it entirely. But then, how do you think about this ESG rating? Sometimes it becomes very linear scores, or maybe multiple scores. But then, we talked about ESG can be the return enhancements. But then, how do you think about the ESG scoring at your company? Maybe starting with Jing.
Okay. I think we all know the issues or gaps that are in the current ESG scoring system, whether it's any of the providers, and they do have slightly different methodologies. I mean, I think the study was done in terms of correlation between the ESG rating agencies versus, for example, fixed income rating agencies. The correlation is actually very low. So what could be rated very poorly by one agency could be high in another. And the root cause is really either a difference in methodology or even quality of data. And that's a huge challenge for, I think, investors today, is the consistency and quality of data. So a lot of times we are reliant on company disclosures as well as third-party or NGO ratings. And of course, that can be very inconsistent as well. It could be using survey data, small sample size, etc. But it's better than nothing is where I would come from. I think it it is an environment where it's still early stages, and it's hard to have a very definitive handle on how ratings should be and could be. But I think with the evolution of greater transparency about data, especially, for example, on the carbon front, many companies are going on the journey of disclosures on scope 1, 2, 3 emissions, etc. I think we will have a better transparency, just as accounting standards had its own evolution over time. I think the standards for ESG will also evolve and become more mature for us to make better assessments.
Got it. Sounds good. Yeah, I think that's there will be continuously a challenge, and then we can really sometimes show in data, because data is not complete. But then sometimes I think our belief is important, because that will be a driver, and then making the changes. So I think it's like a venture capital investments. At the very beginning, we don't see what is going to happen, but then I know it's right, right? And then so we have to to do it. So hopefully over time we will see the big differences. All right. So the next question is, oh, I'm sorry. So Devyani, do you have any views on this?
Yeah, sure. So I think ESG data, it could be, again, a separate webinar. There's so many different data providers. And I think I read somewhere that the correlation between the ratings of different ESG data providers is 0.6, something like that. So it's not as high as you'd like it to be. And just to contrast that, within credit rating agencies, the correlation between their ratings is 0.99. So you can imagine that a same company might have a completely different rating on Sustainalytics versus MSCI versus whatever other data provider. So I think these ratings are to be taken with a pinch of salt, and they are a useful tool, but they are on their own, not the, I think making investment decisions just on the basis of MSCI ratings, for example, is probably a blunt tool. And just to give you an example, two firms might have the same emissions. They might have the same, for example, carbon emissions in the MSCI data. But for one firm, they're supplying imagine it's a steel company, it's supplying its parts to a wind turbine, versus another firm that's supplying its parts to an industry where there are a lot of emissions. So, those two firms might have the same starting emissions today, but their whole life cycle of emissions, if you think about their where they're supplying their parts and who are their customers, you want to invest money in the firm that's supplying their parts to the wind turbine manufacturer, because over their whole life cycle, if you consider their customers, etc., they have a lower impact or even a positive impact on the environment. So if you just look at emissions data on its own, that's not it's not complete. Also, some high emission businesses, do need investor capital today, as Shinya had mentioned earlier on in this webinar, in order to transition to, more aligned and kind of lower carbon technologies. So they might be high emission industries. They're generally high emission industries if you think about cement, for example. But in order for cement manufacturing to move to more climate aligned and lower carbon technologies, they need investor capital. So I think looking at, for example, emissions at the total portfolio level and just trying to optimize or minimize that using any of these ratings agencies or any of this data is probably suboptimal. I think what is the composition of that data and what is the composition of your portfolio score is equally important.
Got it. Okay. Oh, that's very helpful. We have a couple more questions, but then we have a limited times, and then just to combine a couple of questions into one, and then so the audience are asking, do you think the ESG is a bubble, especially in E, right? And then would you be more interested in someone who is focusing on S and G, a little bit of contrarian move, I think. And then, of course, ESG or sustainable investments, it's not restricted on E, S, and G. I think we just conveniently just put together, but then we don't have to limit, our focus and resource on E, S, and G. We can be, we can go beyond for sure. But then sometimes, there's a trend, and then the people tend to focus too much on, one segment and then forget about the other, the segments of those, impact and sustainable investing. Do you have any views on this?
With the benefit of age, we've been through many bubbles in our industry. and also, what are crowded trades, right? So we all know the outcomes of those, and I think first principles always apply. Use your judgment as analysts and as investors to really assess, because there's no right answer and there's no straight answer as well. The world of sustainable investing is also so diverse compared to what we're used to, for the past 20, 30 years of investing, is that, suddenly it's actually multiple objectives and priorities that have come in. So, of all the UN SDG goals, I think they different people and different organizations gravitate to different ones. For example, our own, we have chosen 6 that we will focus on. Another company may have chosen another 5 that are different. And therein lies the beauty of this whole area, is that different types of investors will be investing in different types of companies. I think we can all agree that all of the goals are very worthy ones from a long-term perspective for the long-term sustainability of our planet, not just for or just also the people aspects on the social and governance aspect. So I think we can all agree that all of the goals are relevant, but which ones are we more interested in or more sort of engaged about is going to be different. So I do think that the rising complexity, as well as the rising interest in different areas, will be much more important than saying that is this going to be the money maker or spinner for the next year or so. And I think to the person who basically raised this question, I think there's definitely risks involved in climate investing as well. And certainly there will always be risks in overvalued companies or crowdedness. So it's very important to still apply the very important financial rigor that we are more familiar with to our investments as well, and also hold companies accountable, because what's on the tin may not always be fulfill the actual objectives that the investors set out for.
Thank you. Devyani?
Sorry. Should I just address the same question?
Oh yeah, well, I'm just curious. Do you think there's a bubble in ESG?
Yeah, sure.
Yeah.
It is a really tough question to answer, and we know that ESG funds and stocks, they do tend to avoid certain industries, or come from specific sectors and industries, and those sectors and industries have more recently done very well. However, I would also say that the managers that we work with, it's not about finding a company that is scoring amazing on ESG or is absolutely the A+ of what a company should be in their sector. It's also about finding companies that are transitioning or have a positive momentum on ESG. And we found that managers who focus on those companies, within those companies there is a scope for better price appreciation as well, and those companies might not be as richly valued. So I think definitely there could be pockets that are overvalued, but there continue to be opportunities within the sectors that these kind of ESG managers focus on.
Got it. Okay. Well, this conversation kind of reminds me of my the senior who gave me at the very the early of my career. He said, if there's an acronym and then people using only acronyms, just be careful. It could be a bubble. And then do you remember BRICS? Maybe it's not nobody's talking about BRICS anymore. But then back in 2007, BRICS was all over the place. And then it's quite interesting. And hopefully the ESG is not going to be like this. And then I don't think that will be the case. But then I think we and also the next generations have to be reminded of this, and then just how we can actually make it sustainable. So the last question for today's the panel discussion is a little bit self-serving for the Gen Z, the Z Club and the ESG Academy. But then I think this is a very important question for students. So do you think the next generation analysts should focus on ESG. Would you hire those people, or do you think this is going to be on high demand in the future, especially in Asia? Devyani?
Sure. I'd say yes. I mean, but also that is coming from a personal place of, I'm interested in this, and to me, it makes sense. I think this is an ever-growing area, and it's as important, I think, today to know, at least have some basic baseline knowledge about sustainability as it is to be able to, do kind of a DCF, or to know how to use Bloomberg and Excel. So I'd say that it is, to me, I think it is going to be less of a distinguisher that you have knowledge about this, and more of a distinguisher if you don't have knowledge about this, and not in a positive way. I think that is kind of where I'm coming from.
I'm a bit more old school. I'm a fundamentalist as far as academic knowledge is concerned. I always believe that you will excel in what you're passionate about. And it may not be ESG. It might be data analytics. It might be, I don't know, animals. It might be something else. I think at the end of the day, do what your heart and your talent lends you. Maybe it's music, maybe something else. Because at the end of the day, what the market values, as I always say, is transient. The engineers of the past have come into vogue again. Perhaps we will have an oversupply of certain jobs and certain degrees. At the end of the day, if you are passionate about it, go really deep in, and I think it will ultimately serve you. And the area of ESG is so wide that I am much potentially more likely to hire environmental scientists today than a financial professional if I want to focus on a climate fund, for instance. But at the same time, I could very well be hiring a zoologist if I am a biodiversity-focused investor or company. So I think it's more important to really develop your passion, more because you are truly committed and interested, because it may not pay you well for a long time to come. And frankly, I've talked to many of the environmentalists today, from WWF, whatever. The money was never their motivation. But today, maybe they're very in demand. They could possibly get a job anywhere because, frankly, every job site has an E somewhere or an S or G today. So it's just very fortuitous that what they were passionate about has finally been valued correctly. But it may not be the case as well. There will be areas that are probably paying very poorly for many years to come. But the individuals involved in the industry be extremely motivated and really create change. Take, for example, COVID-19. I mean, the scientists in Oxford, for instance, have been working on this for many decades before they were able to come up with a vaccine. But, the price of the vaccine or what was not their intention. They didn't intend this to become a profitable endeavor. Well, touch wood, they didn't want it. But, it so happens that way. So I think my approach to academia is always, be passionate about the subject. Then whatever financial outcomes come, it's cream on the cake. One day it'll be valued, maybe not in your lifetime or in your lifetime. So be it, that's great for you. But ultimately, I look at passion and actual expertise for the area I'm hiring for. I don't look at people's credentials necessarily alone. Of course, it adds up. Like Devyani said, it could become the lowest common denominator, like CFA past, ESG, or indeed the next three-letter word, we don't know what it could be. Maybe it's crypto, I don't know. But that's just fads and short-term goals. I think ultimately, as a student of science, as a student of investing, you need to play the long game.
Wow, that's an excellent point. So even though we are, the investment club, but then the girls and boys don't follow money, follow your passion. This is probably the most important takeaway from today's panel. So Jean and then Devyani, thank you so much for your great insights and then sharing. This is amazing sessions, and then we're happy to have both of you for the last the panel discussion of this year's the ESG Academy. And thank you very much, and then hope we can continue the dialogue.
Thank you.
Thank you so much. Absolutely, our pleasure.
Thank you, Jing, Devyani, and Shinya. And it's really insightful to hear about the ESG investing challenges and opportunities you face as asset allocator and the different approaches you are taking to address them. I can see how engaged our audiences are from the quantity and, of course, the quality of questions asked. And to our participants, we have come to the end of our Next Gen ESG Investing Program panel series. Thank you so much for your support, especially on a Sunday morning. And we hope to see you again for our future events. To stay tuned, please subscribe to our newsletters via www.genzgroup.com or connect us on LinkedIn. Our LinkedIn account is Generation Z Investment Club. So thank you all and have a great weekend.